Hello, friends. Welcome to this weekend investing special episode. We try to do some data backed analysis in every episode, and hopefully, our investing, our approach to the market, our behavior improves with each such learning of data backed analytics that we do here. So, let's say there's a group of friends, and one investor says, markets are heated. I will do a SIP when drawdown is greater than 5%, or SIP meaning, I'll add money to the market when the drawdown is greater than 5%. Right now, it is at the highs. Another one says, idle time to invest is when markets are at 15% or more drawdown. I don't want to invest right now. Another one says, idle time, according to me, is 20% or more drawdown. And I just do, when there's blood on the street, and Warren Buffett says, don't invest unless there is blood on the streets. So, everybody has their own view, but who is right, who is wrong, is anybody wrong? So we'll take a look at it from a data point of view. So we've taken 34 years of data to check who has fared better amongst these friends of investors. So let's say now, let's make some assumptions. There are six investors with different perspectives, and all six of them have, let's say, a crore to invest in the markets. Investor A says that I will invest every month, regardless of what happens in the market. 410 months are there in this period. So every month I will invest. Investor B says, I will invest only in a month where the closing of the month is at an all-time high. So whenever markets are hitting all-time high and the month is closing there, he will only invest there. There were only 91 such cases out of 410 months, about 22% of them. Investor C says, I will invest only when drawdown is greater than 10%. 198 months were the cases here. Investor D says, I will invest only when markets are not at an all-time high. So, 78% cases, 319 such months where markets are not at an all-time high. Investor E says, invest only when drawdown is greater than 15%, 155 months. And investor F, the Warren Buffett fan, says, I will invest only when drawdown is greater than 20%, 120 months in the last 410 months, 30% of the times market has been there. And we want to see what is the outcome of such a comparison. Let's now, there are significant assumptions in this, so don't trash the study for want of that there are too many assumptions here. But in theoretical explanations and analysis, you always need to have a lot of assumptions. So let's say they have split their 1 crore capital across all these months. This is a big assumption, but just play along. And they would invest based on their own conditions. So for example, investor A invests 1 crore across 410 months. Okay, so he's investing 25,000 on each occasion. It's theoretical. uh, you may always call this out and say that how did he know that so many months will be there, but just play along for the sake of learning from what is the outcome of such analysis and thesis. So 25,000 was the individual investment amount for this investor A. Investor B only invests when monthly all-time high closes there. 1 crore invested across 91 months. So he invested 1.12 lakhs per instance, and so on and so forth. Uh, the least amount was invested by investor D. Uh, uh, the least amount was when somebody was investing across all months, and the most amount was when they were investing only at all-time high, because that was the least number of months, and others were at 51,000, 32,000, 66,000, 83,000, so on and so forth. They all invested an overall of 1 crore over that time period. Now you need to take a wild guess as to who ends up with the better results, and note it or remember it, and then see when once this result is there in front of you. All investors had a XRR between 12.04% and 12.73%. Imagine somebody who waited years for all-time highs, somebody who was doing it at all-time, non-all-time highs, somebody who waited for 20% drawdowns and invested equally across that. Across different types of investors, different frequency of investing, different SIPs of investing, the XRR was almost the same. Isn't that, an amazing stat to start with? But now let's say, what if all the investors did the same 1 lakh investment with the same conditions instead of different values. So what if, this SIP amount or investment amount was the same for all of them, but they invested at different times and for different months together. So if investor A invested 1 lakh for every month, he invested total of 4 crores. Investor B, he invested only 1 lakh in 91 months when in market was hitting all time high. He could invest only 91 lakhs. Okay, can you see the difference? So let's say there's a salaried person who willing to set aside 1 lakh rupees on every such event. And if the market was more than 10% drawdown, it was only 198 cases, so he was able to invest only one. If that were the case, then what is the sort of problem with this case? The problem, first of all, the problem is that your deployed capital itself is varying a lot, from just 91 lakhs to almost 4 crores. But even after you've deployed, your XIRR, of course, remains the same, but your end value is remarkably different, from others, because you have lost on deploying your money, number one, and number two is on opportunity cost. So the opportunity cost has not been included in this, and a lot of times you would have just waited for your condition to happen, and your money is sitting idle, right? So that opportunity cost is lost when you try to invest basis certain condition of the market. And the person who just didn't bother about anything else, he just invested every month, regardless of all-time high, drawdown, non-all-time high, deep drawdown, same XIRR, you were able to invest the most, able to have the most end value. 4 crores became 55 crores over these 30 odd years, right? So the ability to invest and the ability to, sort of not really look at the market. You're investing every month, every month, every month, and you're saying this is like a holy grail. I don't really care what happens in the market. And this is when you're doing this investment on Nifty. When you will do this investment on strategies which beat Nifty by a wide margin, imagine the kind of returns that will get generated. I mean, I don't even want to guess it here, because you will know what several of these strategies have achieved versus Nifty. So if Nifty can help you achieve this kind of generational wealth over a period of time, then certainly using other strategies which beat the indices can do really wonders to it. So the idea is that to sort of disrupt the thought that, I need to be so intelligent to time the market. I need to only wait for blood on the street. I need to wait only when all-time highs are getting hit. I'll do this when the market is doing XYZ. Nothing like that is required actually. Just very simple, uncomplicated, every month, close your eyes and put your money into the market has worked the best. So now coming to the most asked question of all times, markets are elevated right now. Should I sip or should I wait? So let's get into another example. So now let's say markets are up 50% in the last 1 year, which has been happening in the last 8 years many times. Should I wait for a correction before I can add money? So now this is exactly where most people in the market will make an error. They will sit on the sideline. They will wait. They will wait for the 10% drop even if market goes up 100%. So let's say you were here at 150 and you wanted to add money, but in your mind you are hell-bent that, I will invest only after a 10% correction. And the market goes from 150 to 225 to 230. And then you get that 10% correction. So what have you missed? You've missed this entire rally because you wanted this and it didn't come here. It didn't even come here. It came here. So you have invested at 210 instead of 150 now. And maybe this is the market top for a couple of years, so it may come down to 150 now. And you will lose money on that. Had you invested at 150, maybe you may have only lost your gains from that point. So what are healthy practices for investments? Consider a fixed frequency SIP irrespective of what is happening in the market. I know it is difficult, but that is what really makes the big difference. SIP has two-third probability of success. It wins when the market is choppy and also when the market is bearish. Trying to time your SIP may not significantly add a big difference to your overall outcome, which we have shown in the XIRR returns of various kinds of investing at different frequencies, different amounts spread out on different, end conditions. And return on effort is insignificant is in most cases. So you're making this entire effort, doing all kinds of calculations, waiting with bated breath, keeping your money aside to do things that you wanted to do at the right time in the market, and the end result is the same for the person who has just invested and gone on a vacation. So who is this smarter person? You tell me. And what is your style of investing? How do you time the market? What has been your experience? Does this analysis make any difference to your thought process? Do let us know in the comments. We'll be waiting for them. Thank you so much, and I'll see you in the next one. Bye.